Hi everyone, good evening. So today we have got Sachin Shah with us. He's a fund manager at MK Investment Managers. So Sachin has got over 2 decades of equity experience in Indian equities. So by virtue of his extensive research, he early on realized the need of a framework in which the companies which evasively tricky standing need to be filtered out objectively, leading to development of equal risk. So basically, it's a proprietary tool at MK Investment Managers, which we will be knowing more on from Sachin during the course of this session. So, Sachin, I would request you to start with give us some color on like how your journey started to the equity markets and how it has graduated to current position at MK Investment Managers. Over to you, Sachin.
Thank you, Prince. Thank you, everyone, for giving this opportunity and your time. Really appreciate. So, Prince, as you mentioned, I started my journey in Indian equities nearly almost 26 years back, 1998 to be precise. And over this last 2.5 decades, I've done only one thing, which is listed Indian equities. Uh, I After my academics, which is after I completed my CFA, after my commerce graduation, I took up CFA, and of course, I was always inclined towards equities as an asset class, and that's the reason why I took the path of CFA. So after finishing my academics, I joined as an equity research analyst. I was an equity research analyst for the first 3 to 4 years, and that's where my entire foundation is. I worked with a firm called KBS Capital. I worked with a firm called Probity Research, which over my journey itself got converted into India Infoline. And this is exactly where my foundation got created, understanding how the Indian equity markets, how the overall businesses are evaluated over a period of time. And frankly, if you ask me, it is those first 4 or 5 years which continue with me even today as an analyst. And after that, I got a break with a firm called Motilal Oswal Securities, and I worked with Motilal Oswal Securities for more than 7 years, of which the last 4 years I worked with Mr. Ramdev Agarwal. I was there on the PMS side. Motilal Oswal Securities got their PMS license in sometime in 2003, and I moved on to the PMS side along with Mr. Ramdev ji from 2004. So I have been into portfolio management, fund management, money management as a SEBI registered portfolio manager since 2004. So which is again more than 2 decades now. Uh, I've been with MK Investment Managers now for more than 12 years. I joined MK Investment Managers sometime in the second half of 2011. Today we are 2024, so actually it's 12 and a half years now that I've been with MK. So practically 50% of my journey as a professional has been with MK. Uh, yeah, so we as at MK, we are extremely focused about very research driven equity investing, and this is what I was again mentioning earlier, that my first 4 or 5 years are the foundation about equity research, and our entire approach of equity investing in our portfolio management, in our alternate investment funds. At MK Investment Managers, we are today a SEBI registered portfolio manager. We also have AIFs, the close-ended and the category 3 AIFs, and also now an open-ended AIF. We are also now an advisor to some of the offshore funds. So that's also an interesting part of a new part of our journey. Overall, at this point in time, under our discretionary PMS and AIF, we manage rupees 1,000 crore plus, and plus we have advisory mandates of nearly 250 to 300 crores. So total assets under management at this point in time is rupees 1,300 crores. Our entire focus at MK Investment Managers has been about, as I said, equity research, but within that, the focus is long-term investing and the game of compounding. We strongly believe the eighth wonder of the world, as Einstein mentioned, the game of compounding, and this is something where our entire last 12 years that I have been with MK, we have focused on that. We have got a lot of compounders in our portfolio. When I say compounders, means that we own a lot of businesses in our portfolios for last 7, 8, 9, 10 years. In fact, 75% of our current portfolio in our flagship portfolio PMS strategy is with 7 to 10 years of vintage. So that's the kind of the focus that we have. And of course, to have that compounding play in the portfolio, I think two very critical essential things: quality of the management and quality of the business. And within that, again, quality of the management is paramount. The equal model that you were just mentioning about is our proprietary module, which we created almost 12 years back when I joined MK. And for this 12 years, we have very religiously, very diligently followed this. And thanks to this model, we have studied very well over the 12 years. Very, very happy to say that over the last 12 years, we've not had a single blow up in terms of any single stock as far as corporate governance is concerned in our portfolio over the last 12 years. So this is how I would like to sum up. I mean, before we move forward, just as a part of the typical compliance, all the views that I'll be mentioning today are in my personal capacity. And whenever I take if at all, if I take any company stock specific names, that would be more for examples or more for explanation rather than they're definitely not any recommendations. Yeah, Prince, hope that should be okay as opening remarks. Over to you.
Yeah, thanks, Sachin. Quite an impressive and rich experience, I must say. So, Sachin, we all, the market participants were into the election chatter and it happened and it passed. But again, I would like to understand from you the market in the aftermath of election results, how you are placing yourself and what was your before the elections, again, there was uncertainty, right? Which has more or less settled at this point in time. But again, how you handled that phase and how you positioned yourself at MP.
Sure, Prince. Thanks for that question. So, Prince, frankly, I think the way to look at it, I mean, now that in the hindsight, I think before the elections there was much less uncertainty. Uh, Post the exit polls, there was no uncertainty. And once the results started coming out, there was a lot of uncertainty. So actually, it went the other way around from certainty to from less certainty to certainty to very a lot of uncertainty, and that's how we saw some market reactions on 4th of June and then again 5th of June, right? So I think this has been a little bit of a different kind of a scenario than what most of us kind of were expecting. But of course, nevertheless, I think all is well that's ended well. NDA has come back to power. Mr. Modi is back in the driver's seat. So I think that's a very big positive. Coming to our overall portfolio strategy, Prince, as I mentioned earlier, we are seekers of compounders. We are seekers of long-term investing. We really look at investing into very into businesses which are very secular in nature and where there are some mega trends, right? So, for example, let me just give you some examples so it's easy for you guys to relate to what I'm trying to say. I'll start with an industry example and then I'll come to some company specific businesses also. So, for example, today we all are talking about manufacturing as a sector, probably, in fact, high probability that it's going to do much better in India. And this is not what we are saying. We said this more than 2 years back, and that is why we launched a manufacturing focused portfolio called NV, both under PMS and AIF. But today, I mean, just 3 months back, there's a CRISIL report which said that the manufacturing GDP in India will outperform the overall India GDP growth for the next 3 to 5 to 7 years, right? Now, this is a mega trend. And why are we optimistic about manufacturing as a sector? See, there are two, three major, I would say, undercurrents or drivers. For example, one of the big drivers has been the global alternate supply chains. There has been a big trend about that for the last 10 years, I would say. In fact, for the first 5, 7 years, India kind of missed the bus to countries like Indonesia, Vietnam, Thailand, uh, and a few others. But post-COVID, I think, or during COVID and post-COVID, this trend has accelerated even further, where every global purchase manager is very clear that he wants to create an alternate supply chain. Uh, I mean, and we are not saying that they're going to stop sourcing from China. They'll probably source 80%, 90% from China, but they want to have an alternate supply chain of 10, 20, 30% of their requirements from other countries or other bases. Now, there are at least 6 or 7 industries, whether it is specialty chemicals, pharmaceuticals, and within pharmaceuticals, the contract research and manufacturing, the CDMO space, uh, textiles, electronics manufacturing, engineering, within engineering, hardcore engineering, power equipment, so on and so forth, right? These are few industries where Indian corporates have established their domain expertise. Indian corporates have delivered scale and given confidence to the global purchase managers that they can actually, rely on the supply chain from India. And third, where Indian producers in some of the sensitive industries like CRAMS and CDMO are fairly, I think they respect the IPR much better than their counterparts on the China side, right? So this is one big mega trend. Second, another important part is that the young aspirational India, right? The demand for some of this, I would say, aspirational goods. Say, for example, a four-wheeler, for example, an air conditioner, for example, a high-end two-wheeler, for example, some of the high-end consumer durables, or some of the, high-end watches. These are all very aspirational things. So young, aspirational India, thanks to easy financing, thanks to easy access to finance, and thanks to, I would say, the technology led financing available, the demand for such goods is actually is going to exponentially grow over the next few years, right? So these are two big drivers. Along with this, there are a few catalysts like, say, a product linked incentive schemes, the PLI schemes by the government, which really accelerates this capex by the some of the large manufacturing companies. So, what I'm trying to say is that when we see this kind of secular trends, there may be some hiccups, there may not be some hiccups, but over a 3 to 5 year, we always tend to move upwards. So our portfolios are more positioned towards this kind of mega trends. For example, say, now I'm just going to give you one company specific again as an example. Say a company like DV's Lab. DV's Lab is a contract research and manufacturing CDMO space company. It's more than a 20-year-old listed company and maybe a 35-year-old company started by a technocrat, Dr. Murli Divi. Over this last 2.5, 3 decades, it's already a more than $1 billion revenue with almost 3,000 crore plus profits, and the kind of the capex that they are doing, because their customers are all global pharma companies like the Abbotts, Pfizer's, Glaxo's of the world, of those types, and the kind of the demand requirement that they get from some of these large customers gives them confidence to do capexes of 2,000, 3,000, 4,000 crores. Something that they haven't done over the last 10 years cumulatively is what they're doing on the next 2, 3 years cumulatively, right? So that's the scale that they are going into. Now, when we see this kind of mega trends, whether it's textiles, whether it is electronics manufacturing, whether it is your power equipments, whether it is even into hardcore engineering, some of the gear businesses that we have invested into. So, this is the mega trend that we look for. So, when this kind of large events that happen in terms of the elections and all of that, we don't believe that they can change the trend. They can only give you opportunities, if at all, to invest more. If there is some upset, like we saw on the 4th of June and those kind of things. So actually, we were more of investors when we saw markets were, dropping very significantly on that day rather than anything else. Yeah, Prince.
Great, Sachin. Yeah. So, Sachin, although you mentioned a few of them, but which sectors and themes to watch out from here, apart from the few you already mentioned? And if one has to start from today, so how one should be placing himself or herself on that front? Yeah.
Sure. So, Prince, as I mentioned clearly, some of the sectors that I mentioned in the manufacturing side. The other very big sector, I think, is also where we are fairly optimistic is auto and auto ancillaries. We believe that today India's demand for four-wheelers is just about 4 million cars, which is a fraction of what China is, where today we are. And obviously, as our per capita GDP from $2,500 goes in the range of 3,500 to 5,000 over the next 7 years, I think this segment is going to literally explode. This is going to be an exponential kind of growth. I mean, there may be years where there will be a single digit growth, but over a next 5 to 7 years, we definitely see a double digit volume growth. More importantly, I think in every segment, not only in auto, the big trend that we are seeing is the trend of premiumization, right? The young aspirational India wants the best in the class. They want the top of the line, right? So, for example, say in auto, if you just take a classic example of say Maruti, which is the largest automaker in India with nearly 45-50% market share. What has happened is that first within the auto itself, not Maruti, but just overall within the auto, SUVs as a segment, which used to be less than 20% of the market, has now become 50% of the market in volume term, nearly 50%, right? In fact, I think it's higher than 50% now in some of the months. So when you have that, the customer moving from a sedan to a SUV, even if the volume growth may be single digit, but the value growth is significantly higher because the price of a SUV is far more compared to a sedan, an average SUV versus an average sedan. That's first. Second, as I was giving an example of say Maruti, within Maruti, the highest selling model for any, or highest selling variant for any model was always the number two from the base model or the base variant, right? Today, I think that is changing quite significantly, and it is the second highest model or the second highest variant for any model for Maruti, right? So again, the customers are looking for much more features in their car. They want a much more loaded car with a music system, with a power window, with a sun moon roof, with a better upholstery, with a better dashboard, electronic dashboards. So again, the value of the car increases significantly. So we believe auto and auto ancillaries is something which is very aspirational and will continue to do well. The other very big trend that we are also seeing is in terms of the building products. Today, we are seeing people are post-COVID particularly, the average size of homes are increasing. Within that again, people are really spending a lot on their better houses in terms of interior designing. So all those building product materials is also a very big mega trend as far as the domestic market is concerned. On the export side, I have already mentioned some of the sectors, which is the crams, textiles, electronics manufacturing, power equipment. I think power equipment can also be a very large sector in India because with this green power, there will be a need to upgrade a lot of infrastructure in terms of the transmission towers, in terms of the distribution transformers, because now they need to be more, I would say, equipped for not only the thermal power or the traditional power, but also with the green power. So I think this is where a lot of demand is expected over the next 5 to 7 years, and this is where we are quite optimistic about.
So, Sachin, there are other themes which are quite hot in the market, talk of the town, be it the data centers or the EVs, or maybe you can say power, solar, and whatnot, right? So, obviously, when it comes to the valuations, those are like beyond imagination at this point in time. They are discounting at least 3, 4, 5 years down the line, wherein we are not sure that how it will pan out. So how you will be like looking at those pockets? Are you completely avoiding, or there are some ways to like play those themes as well?
Yeah, that's a good point, Prince. Thanks. Actually, I missed in my earlier point this part. So, Prince, actually, we've also participated in some new age businesses, right? But, I think one of the very important parts about investing is a lot of patience. And, a lot of people mix patience with only after investing. But actually, investing also requires a lot of patience even to invest. Means you need to be patient before you invest, right? Because purchase price, as you rightly mentioned about the valuations. Now I'll just give you a small example. See, again, first of all, why we need to be in the new age businesses. The most critical thing why we need to be in the new age businesses is the reality of life today is that the consumer has moved to the new age businesses, right? The consumers are actually queuing up where the new age businesses are there. Like for example, today Twitter Spaces itself. This is a very, very new media, right? Why am I supposed to be today with you? Because today consumers are there on Twitter. A few years back, it was only print media. After that, it was a television media. Today, now we are in this new age media of tweeters of the world, right? So today, consumers have actually, caught on to the new age businesses. So I'll give you a very simple example, like one of the portfolio holdings that we have is Zomato, right? And we invested in this business almost 18 months to 24 months back, in that range. And we were very, we liked the business model of Zomato when the stock, because we do only listed Indian equity. So at the time of the IPO itself, we were very impressed with the Zomato business model, although it wasn't profitable at all. It was burning a lot of cash, but we saw the inherent profitability in that business, and we understood the business model, and we believe that this is a business model which is very sustainable when it comes to generating free cash flows over the next 5 7 years. Not only free cash flows, but it's going to be highly scalable. So they can easily generate free cash flows in the range of 5,000, 10,000, 15,000 crores over the next 5 to 10 years. So that was our belief, understanding the business model. But at the time of the IPO and the listing, there was so much of euphoria that the stock price actually just rallied significantly in the first 3 to 6 months itself. And we just couldn't invest. After the first 6 to 9 months, I think there was a lot of cool off in the startups, new age businesses, and all the new age businesses kind of corrected by more than 50 to 70% from their all time highs. At that point in time, we got an opportunity to invest into Zomato, and we got at prices around the IPO and also significantly below the IPO, right? That's when we actually created our position in the portfolios, and we still continue to own that business. I don't know how long, but at this point in time, we definitely own that business. So what I'm trying to tell you is that we will always have to be working on, we continue to research and do our homework, be ready when we get the opportunity.
Right, Sachin. Although you touched upon building materials already, but I would request your views around the real estate. After a long consolidation, the sector has been doing pretty well. And on the top of that, like after real estate, the wealth management companies are also doing very well, and there are new AMCs which are coming to the market. So, do you think like all can coexist, seeing the opportunity, or it's like in the past also it happened and then consolidation happened in those areas? So these were the two pockets I would request your views around.
Sure. So, Prince, I'll start with the second part of the question, which is the wealth management businesses. So, wealth management businesses, and also I would include along with that, stroke asset management companies, which are fairly interlinked to each other, right? So I think they both have a great future, uh, because they do a tremendously good job for investors. They definitely add a lot of value. Today, you can imagine, if you go back to the days of Harshad Mehta euphoria. You go back to the days of 2000, 2001 euphoria during the IT heydays. You go back to the heydays of 2007, 8, when there were, from 2004 to 2008, a lot of companies did, overall market euphoria. But so many companies within the Nifty itself, uh, have, have destroyed tremendous amount of shareholder wealth, minority shareholders wealth post 2008, and particularly from 2011, 12, 13, we have seen for the last 10 to 12 years the SIP culture in mutual funds. A lot of equity investments are getting, actually, I would say, channelized through the mutual funds and particularly through the SIPs. So obviously it's the wealth managers who are driving their investors to invest in a very disciplined fashion, to invest with the right vehicles, not to go and do any direct equity investing by investing into speculative stocks and those kind of things. And that is what has given confidence to investors that they can actually earn much better returns than their bank FDs over a longer period of time. Now, this foundation has done a lot of good work, has earned a lot of goodwill for the wealth managers and also for the asset management companies, right? All the mutual funds. They all have done a fantastic job over the last 13, 14, 15 years, delivering at least 12 to 13, 14% returns. In some cases, maybe even 20%. But I would say bare minimum, they all have delivered returns in the range of 12 to 13% compounded over the last 10, 12 years, which is at least 50% higher than the bank fixed deposit rates, right? So that's the kind of the wealth creation that has happened with the investors, and that's the kind of the foundation goodwill that this businesses have created for themselves. So obviously, investors will now, with give them more money to invest for themselves. So I see a very bright future for some of these wealth management firms and also the asset management companies. Coming to your question on the real estate side, I think, like any other asset class, real estate itself is a very cyclical business. It will have its own ups and downs, and it will have its own euphorias and busts, right? We saw from 2004 till 2009, there was a big runway in real estate. Then from 2009 to 14 also it did okay, not bad. I would say in fact pretty decent. But from 2014 till almost 2021, 22, 8 years, the euphoria kind of kept on fizzling down across the country. And then after that, sometime now it's kind of bottomed out and it's again coming back. So I think the way to look at it is that if you are investing in a real estate, you need to see, you have to make sure that you are investing for the full cycle. You can't be investing for 2, 3, 4 years. And when you invest for the full cycle of those 9, 10, 11 years, you will get returns which are better than the fixed deposits for sure. Maybe at least 20, 30% better than that. And the volatility will also be much lower than the equity market. So that's the kind of the trade-off that you have. The returns will be lower than listed equities, but the returns, the volatility will be lower than the equities, but the returns will also be lower than the equities. But the returns will be higher than the bank FDs in real estate. So I think one should be very clear what is their priority and accordingly take exposure to real estate stocks. But there is no running away from the cyclicality of that asset class.
Fair point, Sachin. So, Sachin, equal, although you touched upon, but broadly, if I were to ask you, like, what exactly it does and how it is helpful as far as the screening of companies, so as to filter out the companies on corporate governance, which is a very important aspect.
Sure. So, Prince, basically Equal is a model which is our proprietary model which we created more than 12 years back. And this is focuses on the management quality. Now, essentially management quality is a very subjective thing. Like, for example, I and my head of research would go and meet the company management. Company management will talk everything that is music to our ears. Thanks to Infosys for last 2.5 decades, they have had such beautiful communication to the analyst investor community that all the companies now have learned from them. So they will talk everything that is music to our ears. After the meeting, we will come out and I would be like, oh wow, this is a great management and everything is superb. And my head of research will say, no, this is all bullshit. Look at the track record. Are they really walking the talk? So, in some sense, management quality is being a bit subjective, right? So, as internally we just deliberated on this and we said, can we convert this subjectivity into an objective exercise? That's where we created this module and we said, we will listen to all the managements, we'll understand what they're trying to say, but we would also like to see, are they really walking the talk? So let's look at some of the hard facts, right? So we said to understand the management quality, we subdivided it into five main parts: management integrity, management capability, wealth distribution to minority shareholders, investor communication, and liquidity. These are five main parameters. The idea here is that investing is a game of probability. Like everything in life, investing is also a game of probability. There is no 1 + 1 2. All that we can do in what is in our hands is to keep on reducing of our probability of going wrong. So if we keep on looking at some of the hard data points, and what we said is our model will be based only on publicly available data points. So there's an apple to apple comparison across all companies, right? So that's how we said under management integrity, we jotted down a few parameters. And again, as I said, it was an idea of, game of probability. So say, for example, what is the promoter's shareholding? The thought process here is higher the skin in the game, lower the probability that they would do something silly, right? So, the idea is the maximum public shareholding, maximum promoter holding in a public company is allowed is 75%. So we said anybody who has got 70% or more, we'll give them full marks for that particular parameter, right? If somebody is below 30%, we would like to give 0% for that parameter. Somebody is between 50 to 70, we would like to give 2/3 of the full marks. Somebody is between 30 to 50, we would like to give 1/3 of that. Like that, we will have other parameters like, say, what is the promoter's salary as a percentage of profits, because too much of promoter salary as a percent of profit is definitely compromising minority shareholders' interest, because that will definitely tell me what is the management integrity or management intent towards minority shareholders. Also, in case of multinational companies, what is the royalty as a percentage of profits, right? Who are your auditors? Are they among the big four? Are they known? Are they unknown? We would also like to say, what is the interparty related transaction as a percentage of turnover? We can also look at what has been the equity dilution. There is a parameter over towards that also. In wealth distribution to minority shareholders, we have a couple of large parameters like, say, what is the dividend payout? Has there been a large acquisition? When I say a large acquisition, we've defined it as more than 50% of your balance sheet size. And more often than not, we have seen that large acquisitions haven't played out the way they have been anticipated in the first 3-4 years at least. There have been a lot of drag. Some of the largest companies, the best companies in their sectors, with the best of the intent of the management, with the maximum wherewithalness as far as the financial position is concerned, have actually dragged those companies for 3-4 years because of the large acquisitions, whether it was Tata Steel, Chorus, Tata Motors, JLR, Sun Pharma, Ranbaxy, Bharti Airtel going and doing an African acquisitions. I'm giving you these names which are leaders in their industries, and when they have done acquisitions in the billions of dollars, and for the first 2-3 years, all of them struggle. Some of them struggle for maybe first 5-7 years itself. So, we believe that there's a lot of now publicly available data, and over the last, again, when it comes to our investing process, track record is something what we are extremely focused about. So this equal model talks about a lot of track record, not only the P&L, balance sheet and the cash flows, but a lot of the softer issues also, which we have tried to, tabulate in a very objective fashion. And this has really steadied us very, very well. It has not given any sleepless nights, not only to fund managers or portfolio managers or my equity research team, but also to our investors over the last 10 years. Not a single call we've had during so many wars or during COVIDs or during this change of governments, if at all, or election times, because the portfolios that we build thanks to this equal model gives a lot of comfort, I would say, and of course there is conviction, but more than that, there's a lot of comfort to our investors that they are invested in good hands.
So, Sachin, we are already on time, but one quick question before we part our ways for today. So, basically, one is on the expectations. What is the reasonable expectations from the market? That is one. And on the top of that, which few pockets would be in the list of, untouchables won't be a right word, but again, so as to speak, like not giving comfort, so as to invest or look at this point in time.
Yeah, thanks, Prince. Sorry, what was your first part of the question?
So it was on the what expectations
Yeah,
in the
in terms of
terms
the
of
market, correct.
percentage
Yeah, yeah.
return. Yeah.
So, Prince, actually, if you see calendar, I mean, FY24 itself, last financial year was a bumper year for all of us. Uh, the Nifty gave 30% return, Nifty 500, the product index gave 40% return, mid caps and small caps probably gave 60, 70, 80% returns, right? Uh, at this point in time, definitely valuations are not cheap. I wouldn't say they are in a kind of a exuberant zone, but they are fairly priced. So earnings have to really support over the next, I would say, 4 to 8 quarters for us to even earn double-digit returns from here on. So my expectations would be very, very, I would say, reasonable from here on. Anything I would say double-digit, mid-teens kind of returns should be expected. Nothing too much beyond that, because I think overall also there is a thumb rule that I strongly believe in, that equity returns will typically be on a longer period, 5 to 7 year period, will typically be 1.5 to 2.5x on an average 2 times the risk-free rate, right? So if your risk-free rate today is about 7%, I think the equity return expectation should be in the range of anywhere between 12 to 18%, on an average 14 to 15%. Uh, Over the last 5 7 years, we are already in that compounded rate now because there was a lot of catch up that we had to do. I think that catch up is almost done. So the next 3 to 5 years, I think again a return of anywhere between 12 to 15% will be a reasonable expectation. Coming to your second part, which is a more tricky part, where should we not invest? I think it's a function of every individual's temperament. It's a function of every individual's risk appetite. Uh, we, as I said, are very focused on secular businesses, businesses where there are long-term trends. So we try to avoid investing in very high commodity kind of businesses, where there is a lot of focus on the commodity prices, and particularly some of the commodity prices which are largely international led, or where India is more of a price taker rather than a price maker, or Indian companies are more of price takers rather than price makers. We avoid investing in those companies.
Great, Sachin. So, Sachin, thank you so much for taking out time on a Saturday evening. Really loved the thought process and surely look forward to more sessions down the line. Hope you also enjoyed the same. So, thank you so much for your time.
Wonderful, Prince. Thank you so much. Really nice of you to have me. Thank you. Have a great evening, everyone. Thanks a lot. Bye.
Thanks. And for our audience who joined late, we have recorded the session.